Well, we just finished off the March quarter, during which Australian shares rose just under 7%, which was the third best March quarter we've had in the past 2 decades, and really continues the strong performance Australian and global shares have had since June last year, during which they've both risen around 25%. The interesting thing I think about this rally is that it has entirely been driven by the defensive sectors, such as healthcare, telcos and the banks, as investors continue their search for yield. And this search for yield really is indicative that investors still remain cautious in this environment, primarily because most of the problems in the global economy at the moment are unresolved, and also because earnings growth at the moment remains elusive. In the top 20 markets, 17 of them have expected earnings contraction this year. And really, even though the fact that earnings have been forecast to be going down, but share prices are going up, what that really tells us is that valuations at the moment are looking a little stretched. You know, if we have a look just at the Australian banking sector, it's trading on a PE of around 13 times earnings, 2 times book. And whilst that's not particularly alarming, it is a 20% premium above the 5-year average and could be an indication that maybe better value is evident elsewhere in the market. One place where people are looking at the moment is the resources space, which continues to be subjected to downside pressure as commodity prices come off, and there are some demand concerns emanating out of the Chinese economy at the moment. So in essence, materials have come off about 18% from their peak in February, and that may be opening up some opportunities, but at the moment they're kind of isolated, that there's no sort of like broad sector trend. When we look forward, an interesting thing for me is the fact that a lot of people now, in fact nearly all market analysts, have factored out rate cuts, but with China's growth slowing down and all of the lead indicators in the US economy, namely retail sales, consumer confidence and the manufacturing and service sector PMIs, they've all rolled over, and that is indicative of growth just slowing down in the United States economy. And with that in China and of course the continued troubles in Europe, that tends to suggest to me that rate cuts are probably going to be soon put back on the agenda before too long. What's happening at the moment is that the markets are going through the early stages of the US reporting season. It's a season which investors aren't really expecting a lot in terms of revenue growth and earnings growth, both of which are forecast to be reasonably flat. And after this, probably the next theme the investors are going to be looking at would be the Australian federal budget. And there could be some surprises there. The government's talking a lot about revenue pressures, and that may culminate in an environment where instead of getting 4 surpluses in the next 4 years, we might even get only get 1 or indeed 0. So in that world, debt's going to continue to rise for the Australian government, which is something that markets are probably going to have to adjust to. As we look forward in this environment, probably the key is the strength of each individual company's operating model. What we need are companies who can generate earnings growth in a very subdued economic climate. And if you combine that with companies with strong balance sheets and have attractive share market valuations, then those sort of stocks I think are the ones which are going to be performing quite well. They give downside protection plus upside potential if things should improve.